All right, welcome to This Explainer. Today we're diving straight into a massive dilemma in corporate finance. How on earth do businesses evaluate these massive, game-changing investments when the future is just completely unpredictable? Think about it. When a company decides to build a giant new factory or, launch an entirely new product line, they're laying millions, sometimes literally billions of dollars on the line. And they're doing it all based on what they just think is going to happen years down the road.
It is a high-stakes situation. Would you bet your entire company's future on a wild guess? No way, right? Of course not. But here's the thing. Capital budgeting decisions are inherently about the future, which means they are inherently risky. So today, we're going to build a strategic toolkit to mathematically analyze all that uncertainty. We want to make sure that when you're making a massive financial decision, you aren't just crossing your fingers and guessing. You're making a calculated, risk-adjusted choice.
Here's our quick roadmap for This Explainer. First, defining risk in investing. 2, 5 types of business risk. 3, conventional risk analysis methods. 4, the risk-adjusted discount rate. 5, the certainty equivalent method. And 6, making safer financial decisions. Let's jump right in.
Section 1, defining risk in investing. Let's get really clear on what we actually mean when we talk about financial danger.
So, first things first, it is absolutely crucial that we separate risk from uncertainty. People use the terms interchangeably all the time, but mathematically, they're worlds apart. Uncertainty is the total unknown. It's an unpredictable event you just literally cannot see coming. But risk is something we can actually predict, or at least quantify, using historical data and probability. Basically, we can measure risk. We cannot measure pure uncertainty.
In the context of capital budgeting, risk is simply the variability of your actual cash flows from your estimated cash flows. It's the gap between what you thought you'd make when you eagerly launch the project and what actually ends up hitting the bank account. The wider that potential gap, the riskier the project. And since taking on too many risky projects can seriously drag down the market value of a firm, companies strongly prefer to keep that variability to an absolute minimum.
Moving on to Section 2, 5 types of business risk. Now that we've nailed down the definition, let's look at the specific threats a business actually faces.
Up first is project-specific risk. This happens when your internal estimates just flat-out fail. It's the variability of cash flows due to factors completely isolated to that one single investment. A perfect, brilliant example of this is Tata Motors having to discontinue the Tata Nano. The company made incorrect assumptions about the cash flows and the market acceptance for that specific vehicle. And when reality didn't match the spreadsheet, that massive project risk realized itself.
Then you've got competition risk. This is cash flow variability caused by the completely unforeseen actions of your rivals. We see this literally every single day. Just look at traditional brick-and-mortar retail stores fighting for their lives right now. The immense popularity and explosion of e-commerce completely upended the expected cash flows for physical retailers. It took what used to be historically safe investments and turned them into highly risky ones overnight. Beyond internal stuff or direct competitors, we have broader external factors. There's industry-specific risk. Think sudden tech innovations or material cost changes that rock your entire sector. Next is market risk. This involves massive macro factors like monetary policy shifts or an interest rate hike that hits every company across the board. And finally, international risk. This deals with global factors. For instance, if you have an export-heavy project, it's going to suffer significantly if your domestic currency unexpectedly depreciates against foreign currencies.
Section 3, conventional risk analysis methods. With the threats categorized, the big question is, how do we actually calculate and prepare for them?
Well, financial analysts use a few tried-and-true techniques. You've got the payback period method, which focuses heavily on liquidity by just picking projects that pay you back the fastest. But honestly, it completely ignores the time value of money. So today, we are going to zero in on the mechanics behind two far more robust methods, the risk-adjusted discount rate and the certainty equivalent method.
Section 4, the risk-adjusted discount rate, or RADR. Let's look at how this modifies our required rate of return.
Think of this method like building a financial shock absorber. To find your RADR, you start with a totally safe, risk-free baseline, like the return you'd get on a secure government bond. Then, you simply add a risk premium rate on top of it. This premium is basically the extra compensation investors are demanding for taking on the specific dangers of your new project.
The math here is incredibly straightforward. Let's say your risk-free rate is 8%, meaning you could earn 8% doing absolutely nothing risky at all. Now management looks at your new project and decides the risk premium should be 4%. You add those together and boom, your new RAD becomes 12%. You're now going to force this project to prove it can clear this higher 12% hurdle. This shows exactly how the math works in reality. We take our estimated cash flows after tax for years 1 and 2, but instead of just blindly accepting them at face value, we multiply them by the present value factor tied to our new, stricter 12% radar. By discounting those estimated cash flows at a higher rate, we actively drive down the present value. It gives us a much safer, risk-adjusted number to base our big decisions on.
Now, the trade-off here is really fascinating. The biggest merit of Radar is that it's super simple to use, and it beautifully accounts for both the time value of money and the investor's specific risk preference. But there's a catch. Its biggest flaw is that it blindly assumes risk automatically compounds and increases over time, which isn't true for every single project. Plus, deciding that the risk premium is exactly 4% instead of, say, 3% or 5%, that is highly subjective.
Section 5. The Certainty Equivalent Method, or CE. Because RDR has those limitations, let's look at our second major tool.
So instead of tweaking the discount rate, the CE method uses a coefficient to literally convert your expected risky cash into certain guaranteed cash. It's called the Certainty Equivalent Coefficient, and it's simply the ratio of risk-free cash flows to risky cash flows.
Let's break that down with some numbers. Say a project is projected to generate 15 locks, but you know it's a risky bet. Management sits down and decides, you know what, we would be equally satisfied walking away with a guaranteed risk-free 10 locks instead. By dividing that risk-free 10 locks by the risky 15 locks, you get your coefficient, in this case roughly 0.67. This coefficient is always going to sit right between 0 and 1. Here's how it builds into an actual analysis. You take your initial risky cash flows and multiply them right by your certainty equivalent coefficient. Take a risky 1.14 locks, multiply it by a 0.95 coefficient, and it shrinks down to a safe, certain cash flow of 1.08 locks. Because you've essentially stripped the danger out of the cash flow itself, you can now safely discount it using your standard baseline 8% risk-free rate to find your final present value.
A lot of pros argue this method is superior to Radar because it directly attacks the exact thing that's at risk, the cash flows themselves. It also doesn't make that weird assumption that risk always compounds over time. But obviously it's not perfect. It still heavily relies on management's totally subjective gut feeling of what that CEC ratio should be. And even worse, forecasters might actually intentionally inflate their initial expected cash flows because they know management is just going to shrink them down with the coefficient anyway.
And finally, Section 6, Making Safer Financial Decisions. Let's pull everything together into your key takeaways.
You now have a serious, structured toolkit for capital budgeting. Step 1. Always separate pure, wild uncertainty from quantifiable, predictable risk. Step 2. Pinpoint exactly what type of risk your specific project faces. Is it internal project risk, competition, or global markets? Step 3. Apply the math. You can use RDR to tack a risk premium onto your discount rate, setting a higher hurdle for the project to clear. Or you can use the certainty equivalent method to shrink your expected cash flows right down to a totally safe, risk-free baseline.
Look, the future is always going to be uncertain. There's no crystal ball in corporate finance. But armed with these analytical methods, you aren't just guessing anymore. You're actually bringing logic to the unknown. So I'll leave you with this. The next time you are faced with a massive capital budgeting decision, how will you protect your next major business venture? Will you demand higher returns to justify the risk, or will you demand absolute certainty from your cash flows? Thanks for joining me on this explainer, and keep making those smart, risk-adjusted decisions.